You're listening to AI Prism from Seoul Economic Daily.
Host one alone. It's Tuesday, June 2nd. Here's why global investors are paying attention to Korea today.
So if you're managing a global portfolio right now, you're tracking a pretty massive collision. We're unpacking how this fundamental shift in AI server architecture, plus tightening U.S. export controls, and, a wild reallocation of capital, are basically rewriting the rules for your tech holdings. Like over at GTC Taipei, Nvidia's Jensen Huang just outlined a $200 billion addressable market for CPUs.
Yeah, because the industry is aggressively pivoting from just training AI to inference, like actually running these models in real time.
Right, which means the hardware mix is totally fracturing. We're seeing that GPU to CPU ratio drop from 8 to 1, and it's just hurtling toward parity.
Exactly. And, inference requires massive amounts of immediate context memory. So if you're slotting more CPUs into an AI server rack, every single one of those processors demands an enormous volume of DRAM just to function efficiently alongside the GPUs.
Which obviously puts a huge target on high bandwidth memory, or HBM, which is, basically just stacked DRAM engineered specifically for these AI accelerators.
Yeah, and Samsung and SK Hynix effectively own that entire global supply. But you have to look at how that structural shift actually plays out for someone holding Korean equities.
Right, because it creates a massive concentration risk, doesn't it?
Oh, absolutely. Those two memory giants carry incredibly heavy weights in the hashtag co-SPI.
The Korean benchmark index.
Right. So their HBM yield rates effectively dictate the whole trajectory of the index.
Yeah.
And you can't just model them like a standard Western tech firm.
Yeah.
Because they operate as cable.
Meaning those traditional family-controlled conglomerates.
Exactly. So you have to analyze the founding family's ownership dynamics right alongside the regular corporate management decisions. That dual-layer structure is going to be, frankly, incredibly sensitive ahead of the expected HBM4E announcements and Huang's upcoming Seoul meetings.
But there's also a geopolitical wall going up around that exact hardware, right? Because this memory is just so critical, the U.S. Commerce Department just slammed shut a major loophole that was letting Chinese overseas subsidiaries acquire restricted chips.
Right. That 18-month regulatory gap was a massive blind spot. Hundreds of thousands of restricted chips just flowed through Southeast Asia.
Wow.
Yeah, and now that it's closed, Korean memory makers face a really tricky dual reality. Because they're largely exempt from the direct bans on U.S. logic chips, which is clearly a positive.
Wait, but if they've been using Southeast Asian logistics hubs as transit corridors, aren't they walking right into secondary compliance traps?
That is the exact risk. If your supply chain facilitated that flow, the U.S. does not care if you were the primary target or not. The compliance risks for those regional networks are suddenly a very real liability for your portfolio.
Which totally explains why we're seeing global capital frantically searching for new deployment zones. Just look at Japan. SoftBank just overtook Toyota in market cap for the first time in 22 years. They hit 46.5 trillion yen.
Which is roughly $312 billion US dollars.
Right.
And you have to look at why they hit that number. SoftBank is executing this massive pivot into European AI data centers. It's a 132 trillion won investment.
So that's about 94 billion US dollars.
Exactly. Global allocators are clearly abandoning traditional industrial stalwarts and just pouring into AI platforms.
Sure, but some of these valuations are getting completely detached from reality. SpaceX is targeting a 1.8 trillion US dollar valuation for its IPO.
Which is staggering.
It's 87 times projected revenue. That's double Nvidia's peak. And they're carving out a heavy 30% retail allocation. As an institutional investor, how do you not just balk at that?
You'd really want to, especially since Elon Musk is retaining 85% voting control without an independent board majority. But here is the institutional trap Nasdaq's fast entry rule.
Oh, right.
It could force up to $60 billion US dollars in passive ETF buying within 15 days of that listing.
So if you're holding a passive index, you are basically forced to buy into that governance structure, regardless of the multiple.
Precisely. You really don't have a choice.
Man, that makes the alternative capital flows even more fascinating. Because if passive money is trapped in these skyrocketing, tightly controlled tech giants, where does the active traditional capital go?
Well, look at Warren Buffett. Berkshire Hathaway just made its first major deal under Greg Abel, buying the U.S. homebuilder Taylor Morrison for $6.8 billion US dollars in cash.
Which represents an enterprise value of about 12.9 trillion won, or 8.5 billion US dollars. That is a huge bet on housing.
It's a masterclass in macroeconomic conviction. Berkshire's betting heavily that U.S. housing constraints are structural and persistent.
But bringing back to Asia, how does that U.S. housing boom actually impact Korea?
It creates a very powerful downstream current. If U.S. construction accelerates, you're going to see an immediate demand spike for Korean steel, appliances, and building material exporters.
That's a wild connection to make.
It really leaves you with a critical tension to weigh, though. As index rules force passive capital into increasingly concentrated founder-controlled tech monopolies, will active managers be forced to seek safety in the physical predictability of tangible assets like housing and raw materials? Host 1, alone. That's today's AI Prism, Global Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a 1 IFRO award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.